Hi, I'm Hunter Hill, New Orleans Market President for Iberia Bank. As you may have heard, we've reached a major milestone. Two relationship-driven banks, both leaders in the industry, have joined forces. Iberia Bank and First Horizon are now one company. Together, we will deliver better technology, broader lending capabilities, and an expanded financial network powered by a local team you know and trust. Our relationship-based approach will continue to provide you with the high level of service that you expect. The communities we serve will continue to be at the heart of everything we do. We remain focused on giving back and investing in strategic partnerships here in New Orleans. We are excited about this next chapter with you, our associates, and the New Orleans community. Thank you for your ongoing trust. We look forward to continuing to serve you and being better together.
Good morning. I'm Jerry DiColo, City Editor of the Times-Picayune New Orleans Advocate, and welcome to our Personal Finance Forum. Over the next hour, we'll hear from four New Orleans area financial planners with expertise on personal finance, investments, taxes, small business planning, and a host of other topics. The panel's aimed at offering insights into how readers can navigate our current economic environment, with many workers and businesses stung by the coronavirus pandemic and the economic shutdowns aimed at slowing its spread. Before we begin, though, I'd like to thank our sponsor, Iberia Bank First Horizon. Without their support, we wouldn't be able to host this panel today. So I think most people understand the broad outlines of the financial situation that we're in, but I still think it's important to set the scene. Earlier this week, LSU economist Lawrence Scott released his annual Louisiana Economic Outlook. And in it, he noted that the New Orleans metro area lost almost 100,000 jobs at the depths of the coronavirus shutdowns. And while we've recovered a number of those jobs since then, expectations there are that we won't recover all of those jobs until at least 2022 or beyond. Businesses are coming back, but many remain shuttered. Some people have regained their jobs, but many remain unemployed. So what are the things that workers can do in these difficult times? What are the things that small businesses can do in these difficult times to get them through? Joining me to discuss this are four New Orleans area experts on personal finance and investments, and I'm happy to introduce you to them now. John Ginn, he's a certified financial planner and former Times-Picayune personal finance columnist. He is the founder of Metairie-based Ginn Wealth Management Partners. Desiree Kelly, she's a certified financial planner and a financial advisor at Raymond James. Sharon B. Cassier, a certified public accountant and director of the tax services group at Postlethwaite and Netterville. And Harriet Johnson Brackey, a certified financial planner and portfolio manager at Iberia Wealth Advisors, a division of First Horizon Bank. So first of all, thank you all for joining me this morning. Really excited to have this discussion with you all. I'd like to kick it off with a question to you, John, that looks at where we are in this recession or maybe even recovery. Earlier this year, the economy screeched to a halt, not just in New Orleans, but everywhere. Travel virtually stopped, restaurants, bars, movie theaters, you name it, across the entire planet shut down. At one point, oil supplies were so high that oil prices turned negative. And like I said earlier, 100,000 people in New Orleans had lost their jobs, or nearly that. So there's been a recovery in recent months, I guess, to some degree. Are we out of the woods?
Yeah, good morning, Jerry. Certainly this year it's a year that is unlike any other. To give some historical background, early this year, we started the economy being very, very strong. Record low unemployment, record high in the stock market, And then in February, we got wind of this pandemic that started out in Asia, and it quickly spread from Asia to Europe and then to the US. What is different about this pandemic is that in the past, these types of viruses, has always been in somebody else's backyard, not, in our own backyard. So following the pandemic, the lockdown, we saw a very, very volatile market where from the highs of the stock market, it declined 35%. Of course, the Federal Reserve stepped in along with Congress, opened up its checkbook, and the Federal Reserve basically pushed interest rates to near zero, provided plenty of liquidity, and there was stimulus, all right, that is taking place, right now. So it did seem to put at least a lower level into the market. And then as quickly as the market declined, the market recovered, So when we kind of look at where we are right now, we went through a very, very quick recession. However, going forward, as you mentioned earlier in the program, it's going to probably take several years. In the Louisiana area, because we are so hospitality and energy centric, that's going to take a lot longer. We have lost so many jobs, 100,000 jobs. And, when you look at the prospects, the only bright spot that we are currently seeing is with low interest rates, housing market locally has been quite strong. I think people that are used to working from home, they are now thinking, I don't have to go into the office. Maybe I need a little bit more space. Maybe I need to go outside, of the central business district. So I would say that where we are right now is there is a bit of stability, but going forward, most of the economic forecast that came out originally during the pandemic was very, very gloomy. And they have been revised where it's not quite as bad, but still, it's still going to take several years, that we're going to see any type of recovery, especially in this area.
Desiree, one of the things that has kept millions of Americans in their homes and just putting food on the table over the last several months has been the $2 trillion economic rescue package that was passed by the federal government several months back. A lot of the programs were designed to to limit the short-term impact, but I think we're still suffering through a lot of the impact right now. I'd be curious if you could maybe go through a little bit for our viewers some of the things that are maybe still available out there within the program that might be valuable or might be of use.
Sure, Jerry. Good morning. The CARES Act was passed on March 27th, and while, like you said, a lot of the things that were passed had an immediate impact, there are still things you can do with regard to retirement plans. The purpose of the CARES Act was to stimulate the economy and also provide relief for Americans. And what they did is they suspended required minimum distributions from retirement plans for 2020. Essentially, retirees have to start taking distributions from their retirement plans, and that's so the government can collect the taxes due on those distributions. So one of the things the CARES Act did is suspend those required minimum distributions for 2020 and saving you the taxes that would be due on that distribution. Now, many retirees rely on this income, and so they'll still want to take it. But if you are in the position where you're just taking it because you have to and you wait until the end of the year, then that's a good opportunity. You can contact your financial advisor and suspend that distribution. The CARES Act also opened up the ability to take distributions from retirement plans without penalty. Typically, if you're under 59 and a half, you would have a 10% early withdrawal penalty if you took a distribution from any 401k or IRA balance. And the CARES Act created a coronavirus-related distribution, or a CRD, that allows you to access that balance without that 10% early withdrawal penalty. It's important to note that if you're trying to take that distribution from an employer-sponsored plan, they have to approve it, or they have to make accommodations for it. It doesn't just happen. It's not automatic. So definitely check with your employer to see if it's available. And if you don't have any of these types of balances to access, just look at your pay stub. If you're contributing, maybe now's the time to, stop contributing, to just open up that flow of income to help you if you're in a bad spot.
Sharon, one of the things that was true of the CARES Act was the number of programs that were designed to help businesses, or large businesses or small businesses. I think the one that everyone knows is the Paycheck Protection Program. Can you give us a sense of where we are in terms of some of those bigger programs that go towards businesses? Have they all been dried up? Are there still things that are available to access?
Sure. Good morning. So the Payroll Protection Program, that one you can no longer apply for. In fact, many businesses now are waiting to see if there's going to be any more relief coming from that one, in the sense that will we be able to deduct the expenses that you borrowed the money from the PPP loan and now you've used the money at one time. The idea was that you were going to be able to deduct those expenses. That was changed recently. They said that is no longer going to be deductible, but we're still hoping that maybe could be changed. There's also the thought that if you had a loan that was less than $150,000, that potentially you don't have to go and apply for the forgiveness process. There is a bill out there right now that could potentially give more PPP loan money. We're waiting to see what's going to happen with that. A lot of our clients, though, they've utilized many of these programs, not just the PPP loan. There's the SBA has another program out there, which is the EIDL loan, which you can get up to $150,000 worth of loan if you qualify for it. It's a 30-year payout. It's a 3.75% interest rate. If you're a nonprofit, it's a 2.75% interest rate. So that is still available for people to go get. And I highly suggest that if you need cash flow, you've already gotten the PPP money and you're waiting for forgiveness on that. And if you need additional money, that's one source. There's also another source, which is a Louisiana Main Street Recovery Program, also known as the MSRP. That is administered through the Treasurer's Office, through John Schroeder's office. And you can go to their website. And it's also, if you Google Louisiana Main Street Recovery Program, you'll find it. There's been quite a few people who have already applied for it, businesses. It's a small business grant. It's not a loan. It's $15,000. People have already applied for it and did not get it, but the loan, or the grant, I should say, has been changed. This happened, I think, around September 4th. So if you applied prior to that, I would suggest going back online, seeing what had changed. Now they're allowing you to pull your tax return up from 2018 or 2019, look at your total expenses, take 75% of that number, reduce it by whatever governmental programs you've already gotten, and then you would get either the lesser of that number or the 15,000. It's a much better process. It's called the Quick Relief Program. And so I would highly suggest that if you've already applied, we're a little put out that you didn't get it, go back, try again, because there were some things that were put in place to help people get it because not enough people were getting it.
Sharon, when you look across all the programs that have come out, what would you say, just in working with small businesses, which ones have worked and which ones have been difficult and which ones haven't? I mean, are there some that just got money to people quickly and seemed to do what they were supposed to do, and others where everyone, you sent in the forms and then you waited and you hoped that something was going to happen and it didn't? I'm curious.
Jerry, it's really been a process. It's been a process. To get the PPP money was a process of, like, the rules kept changing every time you turned around. But eventually people did get the money into their hands, learned what, that we watched for the FAQs as they would come out, or the interim final rules would come out, knew what the money could be spent on and what the limitations were. And now we are waiting on some final nuances to be cleared up to see what the forgiveness amount will be. But I would say the PPP loan program was a big shot in the arm for many businesses that needed it. They got 2.5 months worth of payroll from that, calculated off the prior year, and they were able to use that. Now the program extended from 8 weeks to 24 weeks, which allowed a lot more dollars to be utilized and potentially forgiven. And that was a big break to businesses because they weren't going to be able to get the full amount forgiven. And now a lot of businesses will be able to get the full amount forgiven because of the 24-week covered period.
I see. Harriet, I want to switch topics just briefly. I'm sure we'll come back to what we were talking about in terms of stimulus program, Sharon and Desiree. One of the things that financial advisors and financial planners always tell you is that the trick to getting through these difficult situations is to have a plan already. But if you don't have a plan already, that's where a lot of people end up being, right? That they didn't save enough. They don't have a rainy day fund stocked away. Maybe they have some money in retirement, but it's really not enough, or they haven't invested it maybe as aggressively as they needed to. So this is the like break the glass type of question, right? So you are someone that maybe you own a small business and you've seen your revenue fall over the past several months. Maybe you have had your hours cut back. Maybe you have lost your job, or your significant other has lost their job, and you don't really have a plan right now, right? You haven't been working with an advisor to say these are the things we do in this situation. What are the three things that you say to people like that, to say here are the things you do right now today to kind of try and help you get through here, whether it's actionable things or whether it's just a new way of thinking about your money, your finances, your income?
It's a tough question. I think one of the things you should do if you're in that pickle is use all the resources that the other panelists have brought up. Just start Googling away as to what kind of assistance there might be for somebody in your industry, your position, or your business. That's one thing. So the three things that I would go for is I would take my budget and wrestle it to the ground. I would look at every single item, every subscription, every contribution, every expense, try to reduce them, negotiate with your credit cards, call your cell phone plan and take a lower one, use less data, less cable, everything you can possibly do to bring the budget to the smallest point you can. And I'd look at whatever.
Before you keep going, I think that's a great point. Big businesses know that when they get in trouble with their lender, they call them and say, "We're not paying this month. Can you help us out? We don't have the cash." Probably most consumers don't realize that you can call up your credit card company and say, "Listen, I need another couple of weeks," or you can, particularly in this environment with the changes in forbearance of mortgages, you can call up your mortgage lender and say, "Listen, I just lost my job. I need another month." And so I think that's just a good point. I'll let you keep going, but I just wanted to stress that they're sort of, pick up the phone and call these people and tell them where you are. Yeah.
Do it. And Jerry, the point about that is that they may not be advertising that they're willing to be flexible. So you go and see if you can find it. So the first thing is wrestle the budget to the ground. The second point, not necessarily a financial point, is to get creative. I've noticed a number of people who I know who have lost their jobs or had their hours cut. The first thing they do is go to their social networks and find out where opportunities lie or who might need your skills. I mean, you might have a full-time job today and that's great and you lost it. Somebody might be able to take you on a project basis to do a particular thing for them for a few months. And that might get you over the hump. So get creative, go to your networks, talk to everybody, work on your presentation about what your skills are, and put it out there. Okay. And then, of course, I'm a financial planner and I want you to think about the long term, and I want to make sure that you get to retirement with sufficient savings. But a financial plan isn't a straitjacket. If this is the time you need to break into your retirement savings to keep your family going until you get that next position, then go ahead. And thankfully, the programs that Desiree and Sharon have talked about, they make it a little easier tax-wise and financially to go access the money that you had saved for the long term. You know, I don't want you to forget that there's a long term, but right now, you may have to borrow a little from it.
Yeah, I'm Desiree. I don't know. Maybe you could talk a little bit more if there are programs that are related to. You know, I mentioned the mortgage forbearance program. You know, that was in the CARES Act. Are there any things like that that people should be thinking about when it just comes to, like Harriet said, kind of pick up the phone, and a lot of these things aren't advertised, but maybe there are things that you can do to, you know, that are in some of those provisions that give people a little bit of a break.
Well, certainly, you know, like Harriet mentioned, you never know until you ask. So it's certainly worth asking. And like I talked about earlier with the access to your 401k plan, you have to ask your employer if it's even available. Some of the things about that too that I failed to mention the first time around is they also changed the loan provisions on 401k plans. What they did is they increased how much you could access from your plan from up to 50% of your balance up to $50,000 to 100% of your balance up to $100,000. So, you know, just because you can take these type of coronavirus related distributions doesn't mean you should, because it may derail your plan in the long term. But, you know, a loan you're going to pay back. So you can get access to the money right now, yet you can still stay on track for retirement. So that might be a better option. And the CARES Act did make that, you know, a little bit easier to work with. It also suspended payments until December 31st. So if you're paying on a loan that you took from your 401k, those payments are suspended till December 31st of this year. So that's a little bit of, I guess, relief. Just know too that if you are taking these required minimum distributions from an inherited IRA, like, you know, your parents passed away and they passed on some retirement assets to you, and you're taking those distributions, you don't have to take them and pay the taxes on that either. So these are some of the aspects of the CARES Act that, you know, I was talking to some friends last night, they didn't know about. You know, a lot of people know about the PPP and the more well advertised aspects of it, but these are some things that folks don't know about.
I want to add one thing. There are some provisions in the law now where your employer may offer you some relief on your student loans.
Yes.
And so one of those places where I think you should go and check is your current employer, and ask. A lot of compassionate employers have set up funds and resources for people to help their coworkers. Ask them what's new, what you can get. For example, can you do the 401k loan? Do they have benefits for student loans?
Sharon, I'm curious if you've seen the reaction or differences between industries among different business owners. Are there things that some industries are doing doing better than others right now in terms of getting through this? I mean, obviously, hospitality has been hit because the tourists simply aren't here in New Orleans. The conferences and events simply aren't here. But maybe there are some advantages to being in a particular sector that we could share more broadly, or that people might be able to take advantage of in other areas.
Well, actually, the hospitality industry had to get pretty creative with delivering food to hospitals, to, if there were other businesses that would normally have food all around them and it's not there anymore because the restaurants have closed, certain businesses have been able to do contracts to get extra revenue and keep people on board. Also, there's one group that's been publicized that has switched their hospitality workers to telehealth workers, where they're taking calls and helping to reschedule the hospital visits or their clinic visits. That was pretty creative, I thought. And if you think about the distilleries, whenever they switched over to making hand sanitizers, it's what Harriet was saying. You have to get creative with what you have available to you, and what do you do about it? So yes, we've had people that had to switch from doing whatever their traditional business was to doing something different to stay afloat. Whether it's now we have tables outside and we're using streeteries or parkettes or whatever it's called right now, on the street. You just had to do something different. If you didn't normally do takeout, now you're doing takeout if you're in the hospitality industry. A lot of businesses have, I'll tell you from an accounting perspective, they have learned to do things with their employees from home, where everybody was going to the office at one time. Well, now they've learned people can work from home if they need to. And they've used more online softwares and switched their accounting softwares for the most part from being on a desktop to being in the cloud. There's been a lot of changes in the accounting industry that had to happen because of this. And the good thing was a lot of business had already started going towards that trend. This just was the impetus to make it happen for a lot of businesses. So yes, you have to get creative.
Mm-hmm. John, I want to come back to you and talk a little bit more about markets before we go to some questions that some of our readers have sent in. I think if you were to ask the average person on the street, given where we are with the shutdown still occurring across the U.S. in New Orleans, we're in phase 3 in Louisiana, but that still doesn't mean we're back to business. And you were to ask them where the stock market is right now, they would not tell you that we are back to record highs on the S&P and that we've recovered almost all of the losses that we had from March and April. What do you think is the reason for the disconnect between Main Street and Wall Street right now?
I think the main disconnect is that, the market averages like the S&P 500 reflects what the current U.S. economy is doing. So a lot of our clients own energy stocks, for instance, because, being in this local area, we are very energy centric. And, for instance, at the end of August, ExxonMobil was deleted from the Dow Jones Industrial Average. And, people ask, well, why did that happen? Well, for those of you that have a sense of history, if you go back, say, in the early 70s, when we had the oil embargo, there were gas lines. People was lined up to get gasoline. And at the end of 1980, the energy weighting in the S&P 500 was at 28%. And more recently, the energy weighting in the S&P 500 is below 2.5%. Now, so what is happening is that, you have to kind of keep up with what's going on. Today we live in a service technology-based economy, and technology right now is the largest sector in the S&P 500. So if you don't kind of keep up with where the economy is going, you are going to lag. So many people own individual legacy stocks, maybe the old economy stocks, and they will find out that they are below water. So when they look at their account balances, they realize that, oh my goodness, the stocks that I've held for dividend purposes for many, many years, has not gone back to where it was. So I think it makes sense that over time that you kind of keep up, maybe do a portfolio review to make sure that you are in alignment with where the economy is going.
Is this all? I mean, is the market move and that we've seen the recovery. I mean, it's been driven by tech, right? It's been driven by Apple, Google, Microsoft, Facebook. You know, I guess the thing that I'm trying to understand is how much of it is driven by tech, and how much is it driven by the fact that the Federal Reserve said they're going to keep the economy humming no matter what, and that we just put $2 trillion into the U.S. economy, and potentially could be printing trillions more and putting it in. I mean, how much of this is fiscal and monetary policy, and how much of this is everyone being on their iPhone or being on a Zoom call constantly throughout the day?
It's actually both. If you go back to the last market shock that we had, the financial crisis of 2008 and early 2009, you know, the Federal Reserve playbook is very, very similar. They tend to manipulate interest rates because what drives economic growth in the US is roughly 2/3. So if you push interest rates to near zero, consumers will continue to borrow money, provided they have jobs, you know, to stabilize the housing market, auto sales. So what also is happening is that with all this liquidity, you know, money in CDs, for instance, interest-bearing accounts are not paying anything. So with all this liquidity, that money eventually will find its way back into the market because there's nowhere else to go. And of course, you know, the trends that we have seen the last 10 years, for instance, with the brick and mortar retailers that is giving way to the, you know, online presence, you know, that has accelerated during this pandemic. So I would say that it's a combination of both, having lots of money, you know, very, very low interest rates, and also the fact that technology has kind of zoomed to the forefront, if you don't mind that, you know, that pun. I mean, if you look at what we're doing right now, it's just a great example of the changes that, you know, that we are pivoting to.
Mm-hmm. Harriet, when John mentions the low interest rates, the thing that I think this makes me think of what you were talking about people and when they have, you know, when they're in need of cash. I know every situation is different. Do you recommend that people take from their retirement before they borrow on a home equity line of credit if they need money? I mean, if your people are looking for cash, you know, how do you balance the fact that, you know, money is cheap, but, you know, how much do you really want to bring on in debt?
I think if I were facing the choice and that was it, those were the only places to go, the first thing I would think about is, could I refinance my mortgage to a lower interest rate and a lower payment? I mean, I think I would go there first because that's going to benefit me over the long term. Okay. It might incur a cost at this time, but it over time will smooth it out. And that's where I would go.
Mm-hmm. Desiree, I mean, do you have any thoughts on that one? That question?
Well, I certainly agree with Harriet with interest rates being so low, and it just kind of gets back to what I was saying. Instead of taking out the funds from your retirement account with the coronavirus related distribution, you could try a loan instead. Now, the coronavirus related distributions, they do allow for you to put that money back in as well. So that's something else to think about. And they give you 3 years. It sounds a little hairy, and that's something that Sharon would have to deal with, is because you'd have to file augmented tax returns if you took out the funds and pay taxes on it and then put it back in. You'd have to augment your tax returns. But just know that anything that can keep you on track is better than, you know, taking the money out and not putting it back. So try those options first.
Great. I want to go to some questions that we had from readers, and there's when I look through them, there's a few that are all on the same topic. There's a few that are you know, kind of jump around, and there's some that are incredibly specific, and then some that ask very, very broad questions. So as I'm reading through these, you know, this is an interesting one. You know, this is the question. I'm a 20-year educator and I could never afford to save like I should have because of my family obligations. Is it too late, and is financial planning expensive?
It's not too late. And you know, of course, I'm a financial planner. I think you should do it any time that you possibly can. But a lot of people, as they move on in years, become what I would call super savers. The kids have gone to college, maybe even the mortgage is paid off, and your income is not committed as it was before. So you become a super saver and you spend 3 years or 5 years just shoving that money into savings and investing. And 3 or 5 years like that can make a tremendous difference for your retirement. You also might think about maybe working an extra year, or you might think about working part-time in retirement. I mean, there are other ways to make it work out. And is financial planning expensive? I don't know. Everybody could answer that question. It's some people charge for plans, some people don't charge for plans. You've got to work out the arrangement that suits you the best.
Jerry, I worked in the education market for years with teachers. And what I would say to that educator is that they may not realize that they've been working in the public sector. They've been paying into a pension all these years. So they may have that benefit that they don't realize that that's been just taken out of their paycheck. And you can also work with a 403B plan. It's like a 401k, but it's for public educators and some hospitals. And I would encourage them to contribute to that. It's easy. It's payroll deduction. You know, you could have somebody that can come into your workplace and that will tell you all about it. So take advantage of those folks and of the pension plan. They come around, I think, once a year and talk about the pension plan. So all that's free to you. So take advantage of that.
I'll ask another question. Should an HSA play a role in a person's long-term financial plan? The potential tax avoidance seems to have the pros of a traditional IRA and a Roth IRA. What's the catch? And I'm sorry, I'm not sure what an HSA is. So maybe whoever grabs this question can tell us what an HSA is and talk through whether it should be part of a financial plan. Sharon, go ahead.
All right. So I'll tell you from the perspective. And the thing is, an HSA is truly, it can be a savings account. You can use it for investments if you're not using it for your medical expenses, but it was originally set up so that you can put, right now, a person over the age of 50 can put $7,000 or $8,000 in it. And if you don't use it, it's an investment account that you can eventually accumulate your medical expenses, and you don't have to draw them out like a flexible spending account right now in the year that you're spending them. You can draw it out later. Just accumulate all of your receipts and draw it out later. It will be not taxable to you when you draw it out because it has to be for qualified medical expenses. And so if you decide that you don't need to use that money, you have other resources to use for your medical expenses, you can accumulate it. So, and that may be what the person was referring to, is that later on, you can also use it very much like an IRA. Let's say you don't have all those medical expenses, but you need to tap into this account. I want to say the age is 65, but I could be wrong about that. There is an age that you can start drawing out of your health savings account, and there's no penalty if it's not for medical expenses, but you will pay tax on it. That's the thing. If you draw it out for medical expenses, it's not taxable. If you draw it out like an IRA, it is taxable to you. And then, of course, I'll let my other FPA friends or financial planning friends talk about, what type of investments you might want to have in there. But you can also invest the money that is sitting there. It doesn't have to sit in just an interest-bearing account.
John, do you have any thoughts on that, or Harriet or Desiree?
Well, I would probably think that depending on your one specific tax situation, where we are tax rate wise, it is probably as low as it's going to get. So given that scenario, if I have to choose between a taxable IRA, contribution with a deduction or Roth, I would be leaning more toward a Roth. All right. So you can, but but you're going to have to probably sit down with maybe your tax advisor or tax preparer to kind of look at where you are to make sure you're doing the right things.
I was going to say a lot of people, Jerry, use that health savings account and just let it accumulate over the many years. And then in retirement, it becomes their account for medical expenses. And people may think that past 65, the government picks up the check for your medical expenses, but there are plenty of copays and things that are not covered. And so that becomes a really nice kitty of money for people down the road.
This is more of a policy question, and we had a few of these. I got a notice that my unemployment insurance payments end this week. I first filed in March when a lot of other hospitality workers did. So I imagine that I'm not alone here. What options do I have available to continue receiving assistance of some kind?
So currently, there is still the state unemployment that is available to individuals. I want to say it's $247, somewhere thereabouts. There is a bill out there right now to extend the unemployment insurance. I think the House has that out there. That would be $450 per month if that gets passed. There's going to be a lot of back and forth. There's going to have to be some collaboration between both sides of the aisle to decide what that amount ends up being, because, and actually I want to say that there is something out there that is available. It's like $300 a month, but there's not enough resources and the states have to put some money into it. And so that's been limited to individuals. So I would say we're just going to have to hold on, wait and see, because there is something being worked right now in Congress to help the individuals that still are unemployed.
But the bottom line is that we're waiting for Congress to get its act together and put together another stimulus plan.
Correct.
How do you think that changes or shifts after the election, whether Trump gets another term or whether Joe Biden is in office?
As far as taxes go, is that where you?
Well, why don't we start with a stimulus plan, and then we can go to taxes afterwards.
I think still that there would need to be collaboration between the both as far as the stimulus program goes. There's been talk on both sides about what would happen there. Again, there would want to be another PPP loan. There's employment. There's also more stimulus checks that they've talked about. Before we've already gotten some stimulus checks for the $2,400 for a married filing joint, $1,200 for a single taxpayer, and then there was money for a household, head of household, and then $500 for those dependents under the age of 17. So now there's talk about doing that again, and also $500 for any dependent, whether it's, a lot of people are taking care of their parents. So you would also get it for those parents also. So there is more talk about more stimulus coming. I would say that would probably be this fall. It could potentially be before, I think it could be before the election.
Anyone else with thoughts or I guess guesses at this point on something like that?
Well, it's been interesting. I guess for the last several months, the conversation has kind of rotated or pivoted to a potential change in leadership in the White House and the impact it may have on the markets. To me, it really has less to do with which party will be in power and more with what's happening with the economy. So if the economy is in a recovery mode, whoever is going to be in power, is not going to put the brakes on the economy by abruptly raising taxes. All right. I think the important thing is, you need to get the economy stabilized first, add whatever incentive that is needed to help, those that are not, working. All right. And then once the recovery takes place later on, then, bump up the tax rate if you want to. I think one of the things that Biden has talked about is, raising tax rates for those earning $400,000 and higher. So I think for the majority of the Americans, it's going to have very little impact on them.
If I can jump in, I just want to point out for investors, as many people are saying, what's going to happen in the market with the election? The first point is an election happens every 4 years. Markets go up, markets go down, regardless of which way elections go. And if you look back in history at the data, markets have gone up under either party and gone down under either party. I'm trying to tell you, the election isn't a cliff that we're going to jump off of and everything's going to be different thereafter. Please, if people are making investment decisions, use logic, use your risk tolerance, have the right asset allocation for you, do all of the things that we talk about, regardless of what's going on in the political world.
Sharon, you want to jump in?
So yeah, I was going to do that. So there are some differences, though, as to what the tax rates will be, depending on if Trump continues on or if Biden becomes president. John alluded to the amount over 400,000. So there's going to be this kind of like this donut hole, if you will, for Social Security taxes coming out of a paycheck. Right now, the Social Security max hits at about $137,000. That would pick up again at $400,000 for those making over 400,000. You'd pay Social Security tax again. Also, Biden has also said for capital gains rates that if you make over $1 million worth of income, then the capital gain rate would go to 39.6. Well, currently it's 15% or 20%, depending on what your tax bracket is. Trump has actually said that he would try to get it back down to a 15%. So there's some real differences in how this would be taxed after the election if Biden were to be president. So yes, we have gotten quite a few calls as to what do I do if Biden becomes president? Should I do something now? And my reaction always is, okay, let's be calm. Let's not do anything drastic. And I agree that with Harriet that you really do have to have your portfolio aligned for whatever your age is. And if you're a young person, remember you have many years to accumulate your wealth. If you're an older person and you already have accumulated your wealth, do you really want to take the risk of selling everything, paying a lower capital gains rate, and then you have a different Congress that decides, oh, we're going to stay with the same capital gains rate? There's a lot that can happen, in the time period that we're talking about, that I would advise people not to make drastic changes, but to plan and be prepared for whatever their portfolio currently has, whatever their tax situation is. I mean, the same thing goes for estate taxes. Right now we have an $11 million exclusion. Well, that could change also if Biden gets elected, because he's also said that he would not have the step up in basis if he gets elected. Right now we have, when a person dies, the widow and or widower, they get a step up in basis, and so do their heirs. Well, that would change if Biden has his way as to how the estate tax would go. So, I mean, there's a lot of changes that could take place. I think a person does need to be aware of what is out there and plan accordingly.
We have about 10 minutes left. And so what I thought would be good to do is I'd like to go around, and since on my screen, John is first clockwise, I'll go John first. I don't know how anyone else's screen is set up. And what I'd like to ask is, if you could tell me what question you get from your clients the most often in the last couple of months or couple of weeks, the one that sticks out at you. It's great if it's sort of the hard question, right? That doesn't always have the simple answer. What is that question been, and how have you responded to it?
Sure. Oftentimes the question is, do I stay in stocks or do I get out? Okay. And I think the best answer, for that type of question where it's all in or all out is my answer is match the right type of investment with the time frame need. And what I simply mean by that is you don't want to have your grocery money invested in stocks. You want to have your grocery money in something nice and safe, like in cash. And so that would be your first line of defense for short-term market volatility. And then let's say that you have a year and a half worth of cash. Then the next layer would be something in fixed income. We don't talk about, or we take for granted, the role of bonds in a diversified portfolio. But really, this year, during the pandemic, the market sell-off, bonds did their job. Okay, bonds are actually up almost 7% on a year-to-date basis. All right. So what bonds do is it provides you with some stability when there's a lot of upheaval in the stock market. So having cash is number one, and then your next layer is fixed income. And then if you're going to invest money for the long term for stocks, usually if you're going to have money invested, it should be money you don't need for 6, 7, 8, 9, 10 years or longer. So it's not all about all or nothing at all, but kind of a blend. All right, stocks, bonds, and cash where it would be appropriate for you.
Harriet?
I second everything that John said there. The most common question that I get now, but it's just the most common question, is some headline will happen, some event will occur in the world, and the client will say, what should I do now? And very often the answer is nothing. That the news events, the headlines of the day are the headlines of the day. Let's go back to, what are you doing with your money? Is your asset allocation right? Is the amount of risk that you're taking right? When are you going to need the money? Is that changed? And do we have the right mix of stocks, bonds, and cash for you at this point in your life? I'm always going to go back to those long-term objectives and norms that I can measure. And I'm going to remind you that over the long term, markets tend to go up. But if you say, sell it all, and you miss the 10 best days, your returns can go from positive to negative in just a short time. And the 10 best days might be right next to the 10 worst days. So it's very hard to make a decision when you're in a panic. That's why I'm going to ask you to just calm down, go look at your goals again, and let's see if anything's really changed for you, not in the headlines. And that's it.
Desiree?
Building on what Harriet said, is emotions are very high right now surrounding the election. And I think both in the office and just socially, that's the questions I get the most. Because it is very polarizing, and then that leads to emotions, and they think you have to go one way or the other. And what I would encourage investors to do is just to take a more detached approach and look at it logically of what might happen in the election. First of all, more important than who's in the White House is, what is the Fed doing? What are earnings doing? What is the recovery look like? So all of these things are very important, as well as the makeup of the House and the Senate. So it's not just a presidential election. And there are considerations if Biden is elected. He has said he would move the corporate tax rate from 28% to 21%. I mean,
the other way.
Sorry about that. And that would have an effect on earnings, but know that he would also, if it's a Democratic sweep, they would more than likely pass a fiscal stimulus, and that would come before any tax hikes, because the economic recovery is, paramount. So just look at it at both sides and know that there's other factors involved, not just who's in the who wins as president.
Sharon?
Yes, sure. So actually, I get more of the questions on the business side. I do also get those questions, but I try to, as I said, let's be calm and not do anything drastic. But the question I get the most right now is, should I go ahead and apply for my PPP loan forgiveness? Should I do my application? And we've stressed, wait, let's see what happens. There may be that $150,000 sweep where all those people that received a loan for under 150,000 gets the full amount forgiven. Why go through the process of filling out the application, turning it in? Once you turn it in, then it's the bank's responsibility or the lender's responsibility to do something with it within 60 days. And then they have to turn it over to the SBA. SBA has to make their decision. If you turn it in, it's in. So I'm stressing, you don't have to turn it in yet. Just wait to do that and see what happens next. You're not required to turn it in because most of the people are using the 24-week covered period, and that will allow them to get the bulk of it or all of it forgiven at this point. So that is the PPP loan. The other thing I get questions on is, can I take advantage of any of these tax credits? You know, one thing we didn't talk about was the FFCRA, which is the First Families Recovery Coronavirus Recovery Act. There are still some people that can use that, businesses where they pay their employee. The employee has to initiate it. It can't be, it's something that the employee has to initiate, but the employer can let the employee know. The employer will get the credit for the full amount paid if they have to stay home and take care of a sick person, or if they're taking care of a child. There are certain rules you have to go and follow. And it's only certain employers that qualify for this. You have to have less than 500 employees. So I would highly suggest, if you're looking for credits, if you're a business looking for credits, look at that one, because there are a lot of people that have qualified for it, and we've utilized that. And also the payroll tax deferral credit, where you don't have to pay your employer portion until 2021 or 2022. The one thing I will mention is this other deferral, the one where it was the president came in and made a, he did the, from the Oval Office, decided to make this law, apologize, but did this thing where you as the employee do not have to have your Social Security tax drawn out of your payroll check. What people don't realize is that, yeah, you're going to get a payroll check cut, right now, you're going to get more money, but come January 1st through April 30th, then you're going to be having to pay that back. It's the employer's decision whether they do that or not. And most employers are deciding not to do this because it's really it's a hard thing to tell your employee in January. And what if that employee is not there anymore? The employer is stuck with the payroll tax and they have to pay it. So those questions we're getting right now, PPP and credits for the most part.
I want to thank everybody for joining us today. I think there were a few things that I just want to run through that I thought were great. That just a couple highlights. I think since we're on that, don't make your investment decisions based on an election. I think was everyone can agree on, or just because there's an election coming up. There are a lot of programs and options out there. You should, if you need help, you should call and ask for it. Whether that be your lenders or anyone else. And the last one is, if you have a plan, stick with it. And if you don't have a plan, get a plan. And so those are the ones that I think we can leave viewers with. I want to thank all of you for joining us today and taking the time to do it. I'm glad that at the Times-Picayune Advocate, we could hold this to give some information to some of our viewers and readers. I'll always want to mention, if you are not a subscriber to the Times-Picayune Advocate, we would love to have you as a subscriber, either digitally or print. And you can get it just by going to NOLA.com. And I also want to thank again our sponsor, Iberia Bank and First Horizon, for allowing us to do this. So thank you, everyone. Thanks for joining us. Have a wonderful day.
Thanks, Jerry.
Thank you.